Carson Black himself now joins us fresh off the stage at the Sohn Investment Conference in London, where this idea was presented. Carson, welcome to you. And how did this get on your radar?
Yeah, actually, this was kind of a funny one in terms of how it landed on our radar. So we came across late summer, early fall, an article on e.l.f. and it was talking about how its stock had, as of February this year, outperformed NVIDIA's stock. And so there was this hype about its growth. And really quickly, we pulled up import data. And this is not exotic data. This is not these credit card analytics data services that cost a lot of money. We pulled up import data just out of curiosity, and we saw that the imports had crashed starting in their fiscal Q4 of 24. And yet their sales were holding up, supposedly, and they were reporting inventory that blew out. So that was really when it was this moment. I mean, it was almost like we could put together a short thesis in just a few hours, really, but we had to do a lot of work to validate that the data was correct and that there weren't alternative explanations for it.
So we've reached out to the company for comment. If they do bring that to us in the next few minutes, we'll mention it. We haven't heard anything back yet. Are these import figures from the company itself?
No. So the source of the data is U.S. Customs and Border Protection. And so there are various database providers that pull this information directly from the bills of lading. And so you have to understand that about 80% of what e.l.f. sells, it imports into the U.S. from China. And so that, and when we looked at it previously, there was a very tight correlation between e.l.f.'s revenue of its U.S. sales of e.l.f. branded product and the imports. And then all of a sudden in e.l.f.'s fiscal Q4, the correlation broke. So in fiscal Q4, the imports crashed about 2/3. They were down about 67% quarter over quarter, but the revenue for the e.l.f. products actually went up a little bit. And so when this is data. It's not exotic to obtain, but we had to validate it. And so we actually spoke with their three of their four largest suppliers in China to corroborate whether the sales had fallen in calendar year 24, and all three, and these firms account for about over 50% of e.l.f.'s imports, at least by weight. So the one caveat here that people have to keep in mind is that the most reliable data metric that we found for the imports, the stuff that's not extrapolated by the data providers, is the weight of the imports in kilograms. And so when you look at e.l.f.'s balance sheet where they report inventory, they report it in dollars. So you have to do a little bit of calculation to adjust kilograms into dollars and dollars into kilograms. But when we did that, we feel that e.l.f. is likely, as of the most recent fiscal quarter, overstating its inventory by about 100%. And more to the point, though, when that happens, that's usually because there's an overstatement of revenue or, revenue and profit. So we estimate that e.l.f. has overstated over the past 3 quarters its revenue and by probably by well over $100 million, probably $130 million to close to $180 million. That's our range based on imports.
Was there anyone kind of on the buy side or in the investment world, or maybe the company itself, who you talked to for kind of the other side of this story? I mean, I'm looking at the data, and basically what you're saying is e.l.f. imports 80%, substantially all of its product is made in China. 80% of its total products are sourced from China. So you're using U.S. imports, the weight of that is a proxy for demand. So your import chart shows that imported demand has fallen off sharply, but that their revenue keeps growing. It would seem to me, though, if this is broad import data and not specific to beauty products, wouldn't there be a lot of companies who we'd have to question how they're growing revenues if import volumes are dropping?
Well, I mean, if you saw a company where substantially all the product it sells, I mean, look, to sell something, you have to actually have it. So the question is, how do they have product to sell and grow sales if their imports have fallen off? So if you have a company that imports substantially all of its product and you see the imports dry up while inventory levels are rising, so that's a key part of the story here. If their inventory was being drawn down, then we'd say, oh, okay, well, they're selling it from existing stocks. but they're not. Their inventory keeps rising at the same time the imports have crashed. And so it doesn't seem like these two things could be true. You can't have rising inventory with rising sales or even reasonably stable sales while you have imports or additions to inventory that are down about 2/3. And again, they went down 2/3 in 1 quarter, and they've stayed down at that level. There has not been a meaningful rebound. So, the only explanation that would fill the gap is that the stuff that they're importing is now such a higher value per item that's plugged the gap. So we did this math, and we basically saw, okay, historically, the value per kilogram of what they import, what goes into inventory, is roughly $18 to $21 per kilogram, 21 to 22. Okay, but for their inventory numbers to be correct, we backed into it. The value of what they're importing would have had to have gone suddenly to about $52 a kilogram. Okay, for years, they're at 18 to 22. Now, we talked with 3 of the 4 largest suppliers, and these suppliers account for over 50% of e.l.f.'s imports by kilogram. And that's, and e.l.f., look, we did talk to e.l.f. We don't do it openly as muddy waters, but we did have conversation with e.l.f., and we asked questions. They said the top suppliers, those relationships have been steady for years. There's been no change there. And when we talked to the top suppliers, they also confirmed, 3 of their 4 top suppliers confirmed that they were selling less to e.l.f. in calendar year 24 than they had been. And one of those companies actually said, oh, e.l.f. had ordered too much inventory in 23, and they're working down their inventory, which, okay, makes sense, except that does not match by any means the blowout in inventory that you see on e.l.f.'s balance sheet.